Hey, babe. Okay, real quick before we dive into today's episode, which is such a juicy one, and we're going to get into all things investing, I want to make sure I let you know about something very cool that is happening very soon. So, in 2 weeks from the launch of today's episode, I will be hosting my first live workshop in the last 4 years. It has been 4 years since I've hosted a live workshop, so you do not want to miss this one because it's going to be oh so good. It's the Build Your Boss Foundation workshop. We're going to talk about money. We're going to be talking about responsibility and trust, confidence, abundance. I have 3 super juicy days all queued up for you. Day 1, we're going to talk about forgetting everything you know about money and what money is really. Day 2, we're centering on the question, how do I build trust and stop resisting money? And day 3, we're going to be talking about rewiring your brain for confidence and abundance. I am so excited for this workshop. If you want to get in the moment that the workshop starts, I highly recommend that you get your sweet little buns over to amyvanmeel.com/boss to register for the event. We are kicking off on June 26th, and I cannot wait to see you there. Welcome to the Manifesting Millions podcast, where we talk about manifestation, money, and practical guidance to creating your dream reality. My name is Amy Van Meel, and I am an experienced coach and transformation guide, obsessed with helping you get out of your own way and create a life that blows your mind each day you wake up. My goal in this podcast is to share practical manifestation, self-awareness, and growth techniques in real talk conversations. So if you're ready to massively transform your reality, your finances, your relationships, and your overall enjoyment of life, you are in the right place. I am absolutely delighted that you're here with me today, babe. Let's get into it. Well, hello, babe. Welcome back to our second episode in the series where we're breaking down the basics of investing. If you haven't listened to last week's episode, then I definitely recommend that you check that out first, as I cover all the basic foundational bits around investing, what it is, trading platforms, etc. Because today we're going to dive deeper into the proverbial rabbit hole, and we're going to focus on different kinds of investment types. We're going to be talking about shares, ETFs, REITs, index funds, what the fuck they are, and what is helpful for you to know at the beginning of your investment journey. Now, I really want to highlight that this whole series of episodes is really for what I'll call early investors. So perhaps you've never invested anything at all, but you're curious, you really want to get started. Maybe you've started investing, but you're like kind of just dipping your toe in the water. If you're a seasoned investor, I mean, absolutely still listen. I'd love to have you still listen, but this is probably not going to be for you. We don't go super deep in these episodes because my whole intent with all of the information in this series of 4 episodes is to make investing approachable and tangible and understandable, relatable for us regular folks who just know that investing is important, but don't really know how to get started. All right. Now, the same thing as last week. If you checked out last week, you'll hear this again, and you will hear this at the beginning of every single one of these episodes, because investing and finances in general is something that we have to be very mindful of in terms of how we're communicating information. So I just want to kick us off with a disclaimer. I am not a financial professional. I am not giving advice of any kind for financial advice, investment advice, or any other form of advice as it relates to finances and or investing. All information that's provided in this podcast, today's episode and the whole series, is intended to expand your knowledge with the understanding that you are 100% responsible for all your financial and investment decisions and actions. We will be talking about investments in the context of the stock market in really broad strokes. My intent for you in these podcast episodes is to make investing and the stock market more approachable and to help you build your foundational confidence so that you can start to leverage the tools and opportunities available to you. Now, while I may share what I use or what I have invested in, this is in no way an endorsement. And if you continue listening to this episode or any of these episodes, it's with the understanding that you agree to what I've just stated and will not in any way hold myself, my company, or anything or anyone else liable for your decisions, actions, or lack thereof. All right. So let's dive into today's episode. So we talked about investing at its basic level, what the stock market is, trading platforms, portfolios, diversifying. That was all covered last week. And again, if you haven't listened to it yet, and none of those terms make sense to you, or if any of those don't make sense to you, then please be sure to go back and listen to that episode first, because that will help frame the context of like today's episode and next week's episode, make it all a bit more easy to digest. All right. So, keeping in mind that the stock market is simply the public collection of all the companies that are publicly traded, and that as long as you are signed up to a trading platform, you have access to buy or sell those companies. Let's understand further some of the different ways that you can buy or sell those companies. That's what we're going to be talking about today. I'm just going to say this again, if you're a bit more advanced, I am not going to be talking about more what I would call more advanced things like options, shorts, futures, etc. I have zero knowledge or experience about them, and they're really more advanced investment tools. If you're an advanced investor, if you're even an intermediate investor, then definitely like keep digging into it. But the intent of these series, and today in particular, is really to keep it approachable and tangible, and open the door for new, and when I say young investors, I don't mean like young, like you have to be in your 20s, but like young in terms of your overall experience with the stock market. All right. So we're keeping it to the basics here. So, beginning with the most basic element of purchasing a stock, which is the simple share. Now, as you remember last week, we said that shares and stocks are used interchangeably for the same thing. In this case, think of a share as buying one piece of a company. So last week I referred to Tesla quite a bit because it's a company that I think everyone is familiar with, only because it's always talked about in the news, whether it's good, bad, or whatever. Today, let's use the example of Apple. So Apple is a publicly traded company. You can purchase shares of Apple on any trading platform that you decide to use. Apple's ticker symbol, that stock code, is AAPL. And I checked as I was prepping for this episode, the share price for one Apple share was $189.98 USD. So in order to purchase one share of Apple, you'd need $190 US available in your trading account to buy an order. Now, for my Canadians who are listening in, Canadian trading accounts, I don't have a Canadian trading account, so I don't know if Apple trades in Canadian dollars. Candidly, my trading account is all in US dollars. I purchase, I buy, I sell all in US dollars, which does mean that, of course, I have to account for the exchange rate when I'm transferring money from my bank account, which is in Canadian dollars, to my trading account, which is in US dollars. For the purpose of this episode, we're going to be talking about share pricing all as US dollars, but definitely dig into your chosen trading platform, which we'll get into further next week's episode, and understand what might be best for you. Okay, so back to buying our one share of Apple. We need our $190 US available in our trading account to execute what is called a buy order. So let's say that you buy 10 shares, and that's your only investment purchase so far. So this means that your portfolio is 100% Apple. We covered this last week. The goal ultimately is to have what's called a diversified portfolio. So having only Apple shares is the opposite of diversified. It's like buying all of one kind of donut. What I'll call old school investing is simply buying direct shares of different companies. So you basically build diversity into your portfolio through what you purchase. So perhaps you buy Apple, and then you buy Coca-Cola, then you buy Burlington Northern, which is a rail company, then you buy Nike, then you buy an oil company, and on and on. And this takes time, research, and of course, capital, aka money, in order to build a diverse portfolio this way. But all of these companies you can buy directly through shares. Now, what if you could buy a whole bunch of companies all at once, instantly building diversity into your investment portfolio? I want to introduce you to ETFs, which is the short form for exchange traded funds. Now, in the finance world, we have two products that are very similar, have very similar acronyms. We have ETFs, which are exchange traded funds and are related to the stock market. And we have EFTs, which are electronic funds transfers and are related to sending money electronically. And to make it even more confusing, if you follow me on Instagram or you've downloaded any of my free bundles, you will know that I also talk about EFT as emotional freedom techniques, which is a healing modality, which has nothing to do with finance. I love it. Like these three letters seem to be very, very popular. Now, the only reason I mention these three different acronyms is so that you're aware and you can keep them straight in your mind. So we are talking today about ETFs, as in exchange traded funds. So I'm doing my best to make this as simple as possible because this can be kind of a complex item. So stick with me and maybe listen to this podcast episode a couple of times and then do a little bit of research as well to help this information come together for you. So there's companies that exist that have bundled a series of publicly traded companies together into one of these ETFs. So that now you can buy one share, aka one piece of this bundle, but inside that piece, you have a plethora of different companies. The business who bundles these together will have different rules that they use to determine what goes into those bundles. So for example, there's a company called ARK, spelled A-R-K, that has several different kinds of ETFs, and they're grouped on differing criteria. So for example, they have an ETF called ARK Innovation ETF, which is a group of companies all brought together under the theme of disruptive innovation. So these are all companies who are engaged in some form of disruptive innovation. Things like DNA technology, automation, AI, fintech, which is short for financial technology, all of this are part of this particular group. Then they have a different ETF called ARK Space Exploration and Innovation ETF. And this is a group of companies, which you may have guessed, all have a theme of space exploration and innovation. And then they have another one that's focused specifically on financial technology. So this is beyond the innovation ETF, which in the context of ARK is sort of like a catch-all of all the different, what I would call themes that ARK is collecting into their different ETFs. This one is specific to just fintech. So fintech, which is short for financial technology, is part of the disruptive innovation, but they also have a dedicated group of companies that are just fintech. Now, each of the companies, so ARK is a company who has these ETFs, and there's lots of different companies that are out there. Each company who has these bundles of companies in their ETFs will have different rules, regulations, balances, and goals for their ETFs. And I don't want to go too deep in here because, man, we could get lost really, really quick. But for example, when we talked about ARK, they have themes, but there also are guidelines, rules, regulations, however they put them together within their business that will dictate, say, for example, how much of a particular company can take up that portfolio. So let's say, for example, they have a limit of only 50 companies in the portfolio, and then they assign percentages. So maybe they say, no one company can take up more than 7% of this portfolio, just as an example. So I'm not going to get into how they balance it all out because now we get super complex. Just understand that By buying one ETF, you are buying this collection, and you don't have to worry about balancing that portfolio. The company that owns that ETF, that is selling that ETF, will do that. And that's really important to know if you have heard anything about balancing your portfolio, which is something that you do need to keep in mind if you are directly, like only directly buying your shares. You're directly buying Apple, you're directly buying Tesla, you're directly buying Coke. Then, yes, of course, you want to be mindful of like, what is the makeup of your portfolio? For those of us who are newer to investing, and if you're just getting started, this is why ETFs are so good because you don't have to worry about that. The company that is managing that ETF does all of that for you. So it's still worth keeping an eye on, obviously. Invest in what you know, but this gives you a great way to get into the stock market in a much more approachable manner and automatically build in some diversity into your investing. All right. Now, we've talked about shares, we've talked about ETFs. We're going to talk very briefly about index funds and mutual funds. And the only reason I'm talking about them on the podcast is because you'll hear a lot of people talking about them. I want you to focus in with me for a few minutes though, because what I'm going to share is going to sound very similar to what I've already said. So if you're doing something extra, like if you're like trying to read and listen to me at the same time, which I don't know how you can do that, but anyway, try to focus in for like 2 minutes. All right. Because it's going to sound like I say the same thing over and over and over again, and it's not. Now, I also want to take a moment to note that I do break this down with really tangible examples inside the Building Fempires program, which is my transformational money program that focuses on building foundational money knowledge, pairs that with scientific knowledge on how the brain and mind works, and shows you how to identify and shift limiting beliefs and how to move into your most financially fearless, unfuckwithable self yet. So if you're keen to learn more about the Building Fempires program and go a little further into the rabbit hole with me, sign up for the waitlist for the next enrollment period by going to amyvanmeal.com/money to see all the details. And of course, I will have that URL in the show notes for you. All right, so index funds and mutual funds. First, keeping in mind that an ETF is a bundle of companies grouped together that you can buy collectively as one share. All right. An index fund it's like a general term for a mutual fund or an exchange traded fund, an ETF, that's designed to follow certain preset rules so that it can replicate the performance of a specified basket of underlying investments, which is to say that it's a collection of companies, but it's set up to follow specific guidelines to keep the collection balanced. Now, what I want you to hear is this, because I'm going to tell you what a mutual fund is. It's going to sound awfully the same. So, an index fund, the way I understand it, and the easiest way I can think of to try to explain it, is that it's a little bit like potato in a way. So, an ETF behaves in a certain way, a mutual fund behaves in a certain way, an index fund behaves in a certain way. These are different avenues that you can invest in. The easiest and most approachable, I think, for early investors is an ETF. Now, a mutual fund is a pooled collection of assets that invests in stocks, bonds, and other securities. When you buy a mutual fund, you get a more diversified holding than you would if you just had an individual security, and you can enjoy the convenience of automatic investing if you meet minimum investment requirements. So all that is to say that a mutual fund is still a collection of things that you can invest in, but it now also includes additional options such as bonds. There's some securities. I don't think there are options involved in mutual funds. But most notably, this is really important for you to know, is that you generally cannot buy a mutual fund on the open market. You need to go through a financial professional, a brokerage firm, or directly through the fund companies themselves. So whereas an ETF is something that you can just go to a trading platform any trading platform that you've signed up for, you can go into and like buy an ETF. In order to purchase a mutual fund, you need to go through very specific portals. Mutual funds, based on my research at least, my understanding is they seem to be more costly. So when you are investing and you're looking at different things like index funds and ETFs, it is worth keeping just like a note in your mind as you grow your investment knowledge and your experience that there are fees associated inside of these funds. For myself, I invest in ARC. I do that directly through my trading platform. So it's no different than if I buy a share of Tesla or I buy a share of Apple. I just do it through my trading platform. And everything is housed within that fund. I don't have to worry about like sending more money into it, right? Um, I will touch on this a little further next week, but I do have a different form of investing as well that is directly through my bank, which operates more like an index fund that's kind of like a mutual fund. And there are fees associated with it. It does grow throughout the year. It's something that I can automatically, like, say, for example, set up $50 a month to send towards, but it has different fees. So if I've lost you right now, I promise it's going to come together, but just go back, listen to this again. The most important thing to know is that an ETF is something that you can purchase directly from the stock market, and a mutual fund is something that you need to go directly through a brokerage firm, a finance professional, or like through the mutual fund company themselves. Okay, so they're not as approachable and they tend to be a little bit more pricey. So, in summation, ETFs, index funds, mutual funds are all collections of companies that you can buy, but each has a slightly different alignment within it. And in the case of mutual funds, there are other financial tools embedded that you cannot buy directly on the stock market. So you might be asking yourself right now, I know when I first started learning about this, I was like, oh my God, which one is the best option? Like, where the fuck do I start? And I do have to give you a bit of an infuriatingly frustrating answer, which is it all depends what you want. So, how I started was with a specific index fund via the investment portal that my bank offered, as I just mentioned. I could set it up to transfer a specific amount of money per month toward it, but I wasn't able to specifically say which fund I wanted to invest in. So, in order to begin, I had to go through an online questionnaire which determined my level of risk tolerance. Basically, was I very adverse to risk and wanted safe investments only, or was I willing to engage in higher risk investments that have a better overall percentage of return, aka a better chance of making money, but would be rockier in the short term? So if my answers place me in a medium risk area, then I was allocated to a medium risk fund. I want to take just a half a second here to just talk about risk tolerance. How do I explain this? So risk tolerance, as I mentioned, is basically like how risk adverse are you? And for folks who are in their 20s, 30s, possibly even in, I would say, probably their first half of their 40s, depending on like your goals in life, and this is why that answer is so frustrating because it really depends what you're looking for. Generally speaking, though, time is on your side, which is really important when it comes to investing. It means that you have time for the stock market to go through its checks and balances. When you hear financial experts, and I mean, hell, just people on the street talking about like recessions or market corrections, the stock market over time, I think historically since its beginning, it's increased something like 8% year over year. It doesn't increase 8% every single year, right? Because we've had all the crashes. We've had the 30s, we've had the 2008 crash, we had the crash in the 80s, we've had the crash in 2014. Like it's all we're hearing, I feel like often, is about how the stock market is crashing. And every time I heard that when I was young, I'm like, okay, but like, I don't see anything going sideways. I don't get it. What happens, because it's a live exchange, and the really important thing I think to remember when it comes to the stock market if you can take a step back and just kind of like have a macro level view of it, the stock market is actually a very emotional exchange of money. And I'm going to use Tesla as an example just because Tesla is a topic that we talk about often in this house. Um, and we, my husband generally stays more on top of like what's happening with the Tesla market. So I don't care how you feel about Tesla. I'm not here to like advocate or um, like talk down Tesla. I just want to talk about like how Tesla functions on the open market. So Tesla as a company has been having fairly consistent success in terms of like how the business is operating. If you were to look strictly at the financials and like take everything else outside of it, Tesla has been consistently growing over the well, I say long term. Tesla hasn't been around that long, but like over the long term, it's been consistently growing. If you were to look at that, you would assume that the Tesla stock price, the share price, should also be consistently growing. But there's a lot of what I'll call fear mongering, a lot of misinformation. This is true in the news in general, but definitely when it comes to investing as well, where there are people who, for whatever reason, don't believe in Tesla, aren't behind Tesla, hate Elon Musk, I don't care, whatever it is. And so there is then advice. There are experts that are brought onto like news shows and in articles and stuff that are basically saying it's not a good investment. You shouldn't buy. The share price is too high, whatever. And when folks listen to that and all of a sudden there's like a whole bunch of people call it dumping their shares. So a whole bunch of people have decided to sell all in one go, then that can bring the stock price down. Now, within the company, nothing has specifically changed. The company itself is still financially healthy and still going, but we have these emotions that are clouding the decisions. And so the share price is going down, right? This is also along the lines of, and I think I touch on this a little bit next week, but like the whole idea of like buy low, sell high. That's the whole goal. And very few people that I know actually do this, which always makes me laugh. When the stock market is crashing, which it always does, long term, it will always, they're called market corrections. It doesn't do it every single year, hopefully. It does it, I think on average, it's like sort of every 7 to 8 years. I seem to recall from my research. So these are natural cycles. They're called a correction. It's, I'm not going to go down I'm not going to go down the rabbit hole because otherwise we'll be here forever. But like basically what happens is like assume the market is getting, call it too hot for whatever reason, and something happens that all the share prices start coming down. What do most people do? Most people see the share prices of the companies that they have like diving. So they all jump on the bandwagon to sell their shares. And then they wait until the market starts to go back up again before they buy back in. But at this point, you are selling as the price is decreasing and you're buying as the price is increasing. So if you can keep that in mind, then something else to keep in mind is and this is where it's good to like start by investing in what you know. If you're familiar with Tesla, if you're familiar with Apple, like Apple, I would say I'm not an investment person and I don't study their financials, but based just purely on like the products that I see, and I have all Apple products and I love Apple. My guess is that Apple is going to consistently be a growing and successful company. So even if, for example, Apple's share prices were dropping right now because there was a market correction happening, if I own Apple, I'm not going to jump on the bandwagon to sell it because I'm investing for the long term. I'm trusting that it's going to correct and it's going to come back up again. So when it comes to bring this whole thing back to risk tolerance, when it comes to risk tolerance, and I teach on this a bit more deeply in Building Empires, you want to be intentional in your investment decisions. So really think about like, how long are you okay with that money being tied up in the market? because the only way that you actualize a loss. I love when people talk about losing money on the stock market. If you haven't sold the stock, you have lost nothing. And by the very same token, on the other side of that coin, if the market is increasing, but you haven't sold that stock, you also haven't gained any money. It only actualizes as a loss or a gain when you do the buying or the selling and that cash money is in your account. All right. So when it comes to risk tolerance, if you have, let's say you're investing $5,000, but you have no plans of needing that for like 10, 15, 20 years. So your risk tolerance is actually pretty high. You could withstand a higher risk investment when we're talking specifically about like index funds, right? If you're investing through your bank or through some financial house, um, because you don't need that cash to be freed up. However, if you're older, um, say late 40s, 50s, 60s, and this investment that you're putting in is intended to help fund your retirement, you are closer to the timeline when you would need access to that money. So then you want to be a bit more secure in your investments. So the difference between higher and lower risk tolerances is basically it's that like, are you willing to ride out the highs and lows? But also it relates almost always directly to how much um, increase your investment can have. A higher risk tolerance is higher risk because there's a chance that it will make a lot more money, but there's also a chance it could go belly up, right? So, like again, coming back to Tesla or Apple, chances are both of those companies are continue to be successful. They're very likely to continue to grow. But like, let's say there was some massive disruptor that showed up on the market, and we'll call it grape, just because we're on the theme of fruit. And grape somehow completely changes the game. And now instead of phones, we have, I don't know, like microchips in our heads. I have no idea. I'm making shit up as we go here. I'm just trying to give you an example. So grape company completely disrupts the market, completely changes how we function with everything. If you think about the first cell phone and then you think about the first iPhone, the iPhone completely changed how we use mobile phones, right? All around the world. It completely changed it overnight. And for my fellow Canucks, BlackBerry is an excellent example of what happens when you're not either ready for that change or you're not pushing that envelope yourself. BlackBerry was a huge success story across Canada, and like everybody had Blackberries. It was a huge disruptor when it came on the market. And then when Apple introduced the iPhone, BlackBerry was obsolete in like a very short amount of time. So if you were invested in BlackBerry at the time, then while it was doing really well, your money was growing. But then because the company didn't adjust and wasn't nimble in that space of like being in that space of disruptive innovation, it sort of went belly up, right? So if you need, let's say you had $5,000 invested in BlackBerry, but you needed that. BlackBerry's not a great example, but I'm just going to use it because we're here now. You needed that money in like a year. If that year was during the time that it was growing, okay, probably not the best investment decision because it is so risky. But if it was in that growth year, you could come out in a year and have like doubled your money, for example. But if, for example, you invested in Apple very early on, at the beginning, Apple was still pushing the boundaries, but it's just consistently grown over time. But it definitely has had up and downs, right? All right. I've definitely went way deeper into risk tolerance than I intended to. But I was just following my gut that was something that I needed to dive and unpack for you a little bit further. So coming back to the index fund that I had invested in through the investment portal for my bank, as I mentioned, I had to go through this questionnaire, and that questionnaire determined what risk level I was willing to take. So the answers, I believe when I finished that questionnaire, it indicated that I was comfortable with a medium risk fund. But I didn't want to be in a medium risk fund. I wanted a higher risk fund because time was very much on my side. And I was willing to ride the ups and the downs for the long term. So in order to change that, if this was just like through the stock market, let's say I don't know, I did some random quiz that was like, hey, Amy, you're like medium adverse. We suggest these stocks for you. Knock yourself out. I could change my mind and be like, no, thank you. I want these other ones. I just go to my trading platform and I just buy what I want. But in this case, because I'm investing through this very specific investment portal through my bank, I actually had to call the bank directly and go through a fairly intensive conversation in order to be able to change and move my investment. Um, my investment. That's it. I don't know what my second word was that I was trying to go for. Change my investment from a medium risk to even like a one level up, right? So like a medium high risk, for example. The very next investment I made, though, was directly on the stock market. I bought an ETF. I had been listening and learning about ARK investments for quite some time at this point. I really liked and aligned with the approach of the company's CEO, a woman named Cathie Wood. And I really liked how the funds were focused. When I looked at this and I paid attention to how Cathie spoke about what was happening in the market and how she spoke about the companies and their different funds, it really made sense to me and it resonated with me. I also believe very much in innovation and strategic disruption. I mean, I worked in tech. As I said, I'm a lover of Apple. I can see the progression of what's happening across the world. But also, as I mentioned earlier, I long ago read invest in what you know. Now, I don't know each company inside the ETF, but I know innovation. I understand disruption. I was aligned with what Cathie Wood was saying. And I was like, okay, this is a person who seems to have set her company up for success. I like how she's doing things. I like how her company's doing things. There was a bit of history already. This ETF had been in the market for a while. I could see how it was performing. So for me, it was an easier investment decision because I had been doing a little bit of research. Now, eventually, I began investing in a few more ETFs before I ultimately made a direct share purchase in Tesla. And again, I'm just going to say this one more time. All of this is my own decisions. None of this is advice. I don't want you to take this and go, Amy said I need to do this. Nope. I'm just sharing my journey with you so you can learn and play with how you want to get started or how you want to grow. Okay. Now, the very last kind of investment option that we're going to cover here today is called a REIT. It's spelled REIT, which is short for Real Estate Investment Trust. Now, if you're keen to grow your wealth through real estate, but maybe you don't have the capital to buy property right now, you may want to explore investing in a REIT. REITs are companies that own, operate, and finance income-generating real estate. So lots of commercial spaces are owned by REITs. There are lots of different REITs available for purchase on the stock market. It's likely that you haven't heard of most of them unless you've been interested in real estate and or have been doing some research and following the market for a while. But if it's your jam, this could be a great way to get started investing or to add some diversity into your portfolio as you grow. So perhaps, for example, you start with a few ETFs, then you decide to purchase a REIT or two to add real estate specific investments into your portfolios. Some ETFs may have real estate holding companies grouped in as well. It's worth have a look into what's included in the company that if you're buying an ETF. But that's one way, one extra way, a different way of investing in real estate without having to straight up buy a house, right? Or straight up buy a mall or something. Okay. We have covered a lot today. If you're the squiggly eye emoji right now, I totally get it. I have spent years trying to learn about investing. Thankfully, my husband is a really knowledgeable guy, and he's really great at explaining things very simply. I would do some research, then I'd bring all my big questions to him. I'd be like, okay, babe, explain to me what the fucking ETF is exactly, or what is a REIT? Is it worth investing in? Have you invested in it? He would always patiently explain things for me. He would share with me well, this is what I've done. Here's why I made this decision, etc. When I reach the point of overload, and this is really important, if you're going to be reaching out to your loved ones or friends or whoever and asking for their thoughts on investments, know a couple of things going in. Like, you are going to get their intellectual and emotional perspective on investing. There are people who just adamantly refuse to invest directly in the stock market. There are people who adamantly refuse to invest in just stocks. That's not quite the right word, but like stocks. So there's also something, we didn't touch on this today, but there's also something called a dividend share. It's actually something that I'm exploring into right now. I know folks who will only purchase dividend stocks. That's it. So they would not, so Tesla is not a dividend stock, for example. They will not purchase Tesla because it's not a dividend stock, right? So everybody has their own rules and regulations that they approach with investing. And so when you're having conversations with folks, just be mindful of that and really just do your best to, I suppose, like, take what resonates from the conversation, but be mindful to not like pick up their belief pattern, right? Because that belief pattern, you don't actually know if that's working for them. So, for example, if you only invest in dividends, maybe that really works for you, but maybe it doesn't work so well for somebody else. Or if you, for example, only invest in REITs or you only invest in ETFs or whatever, it's totally dependent on what makes sense for you. Again, we're talking about like risk tolerance and timeline and all that kind of stuff. So when you're talking with people, try to ask open-ended questions and then kind of like, how do I try to explain this? Like, imagine that you're holding the information that I give you in your hand. So you're not taking it in, you're not like embedding it into your brain. You're just actually holding it on your hand so you can have a look at it and go, okay, what parts of this make sense to me? What's helpful? What do I not want to take with me? And then just like leave that behind. So when I was asking my husband about investing and all the things, he would share with me like what he knows, what he's learned, what he's done, what he's hearing, all that stuff. But because investing is such a deep topic, I would find myself feeling overwhelmed. So the moment that I hit overload, the moment that like, because he will go deep into things. So when I'm like, babe, tell me what a REIT is, he's like, it's blah, 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 blah. And then I'm like, okay. And then might ask one more follow-up question. He's like, it's blah, 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 blah. And then like 20 minutes later, he's still talking about it, but my eyes have glazed over and I am taking nothing in anymore. So now I've learned to just go, okay, I'm good. That's all the space I've got. Thanks so much. Super appreciate it. Because if you get too much information all at once, your brain can't process it. And then you just begin to like freak out and get overwhelmed, right? So this is why I wanted to do this. Like, I'm waving my hand at my computer screen like you can see this. This whole series of episodes is what I mean by this. It's why I wanted to do this as separate episodes where I share some of the basic information for you so that you're not at a total loss. You can build your foundation. You have a jumping off point for growing your wealth. You have some core foundational knowledge that you can lean on as you start researching, exploring, having conversations with people. It's also very much the basis of how I've written Building Vampires, that I have, yes, information on like your subconscious mind and beliefs and um, like what's the word I'm trying to think of? Like tools for like handling your emotions and grounding your nervous system. But I also share, I don't want to say basic in terms of like it's super simple and like it's kind of boring, but like basic as in like core foundation. Um, so foundational knowledge about money. We go into money tools. We talk about credit cards and loans and credit scores and all that kind of jazz, in a way that is just like tangible and makes it clear so you know what the fuck it is and you understand how you can use it, because they're just tools, but we're not taught about how to use these tools, right? All right. So here's your homework for this week. Last week, I asked you to simply start exposing yourself to the stock market. So I suggested to jump onto Yahoo Finance, start playing around for a little while, kind of like look up some companies that you might know, have a peek at some of the charts, and just kind of like step into it, kind of like putting your foot in the pool, not just the toe, but like I'm stepping one foot in up to my ankle, right? Getting a little sense of what's happening here. This week, I want you to take that a little bit further. Start with maybe a Google search, looking up something simple like top 10 ETFs or largest REITs in whatever your country is, and then take that 4-letter stock ticker symbol over to Yahoo Finance and put it in the search bar. Just have a look at the information that comes up. What you're going to see is going to be like a bazillion numbers. And as someone who has developed a healthy respect for numbers, but is not naturally excited about numbers, I can tell you that like when I first started just kind of playing around on Yahoo Finance, I was like, oh my dear sweet Jesus, this is not my jam. But as I just continue to do a little bit at a time, and I start to kind of click around with things, like I think when you first look up a stock, it will just tell you like, you'll see a chart with like a whole bunch of squiggly lines on it. And it'll be like just if it's an open trading day, like today, for example, it will show you, okay, this is how it did today. And the price of stocks literally changes like every second. It's wild. It's actually kind of fun. Like if you want to just like sit and watch the ticker price of a stock go up and down. It's kind of fun to watch the numbers and just be like, oh, look at that. All these people making decisions. But you can change the timelines. Really good thing to maybe try out this week is like go look up Apple, because we've talked about Apple a lot. And when you see the chart, you should see a section that you can change from like 1 day to like 6 months to 1 year to 5 years to I think like lifetime, whatever they call it, lifetime. So you can have a look and like click on the lifetime one and just see how Apple has progressed over time. You'll see like highs and lows, right? It's gone up, it's gone down. But on average, I'm guessing because I haven't actually looked at Apple's overall stock price in a while, but like I'm guessing that overall long term, Apple has a consistent up and to the right, which is what you want, right? If it's going down, if it's like down to the, well, it all goes to the right, but if it's going down, it means the stock price is falling. But if it's going up, obviously the stock price is increasing. I feel like I'm overly explaining this, but that might be just a little bit where my brain is at today. So go check out Apple and just like play with that timeline a little bit to kind of see, oh, okay, oh, so it's a company that you're reasonably familiar with. Even if you don't own anything Apple, you know somebody who owns something Apple. And so you can start to get a look of what it is, plug in some of the ETFs, like look up ARK. If you go directly to, I think if you just Google ARK Invest, you should be able to find ARK's website. But even if you like just put an ARK into the search bar in Yahoo Finance, it should bring up a couple other ETFs. Same thing. You can just go have a look at like the timeline of the price of that stock, how it's gone. And the thing that I love about Yahoo Finance, so I am not a fan of the news at all, and I do not read, listen to, or watch the news at all. But what I like about Yahoo Finance is, so let's say, for example, you're looking up Apple or you're looking up Tesla or you're looking up an ARK ETF, a little lower on the page, it will have like articles where this particular stock is talked about. And then you can just like go have a browse and see like, okay, what's this about, right? It's one of the things I actually quite enjoy about Yahoo Finance. Okay, so the goal of this week's homework. So remember, we're going to go a little bit deeper. So try Googling something like top 10 ETFs or largest REITs in Canada or in US or in, I don't know, Germany, wherever you are. And then take some of those stock ticker, those 4-letter codes back into Yahoo Finance and pop it in the search bar. Have a look. I just want you to further explore and familiarize yourself with the terminology that we've covered today and in this episode. Like we're now 2 episodes in, so in this episode series. All right. The goal here is for you to become a bit more familiar, to make it more accessible, to make it more approachable. We're not talking about buying or selling right now. You're literally just, it's like you're like, if you think about when you were learning how to drive, you didn't just like get in the car and go, right? Like you had a whole bunch of like classroom time talking about the rules of the road. And then you probably got in the car and they're like, okay, so here's the gas pedal, there's the brake, here's the steering wheel, here's your turn signals, which By the way, can we all just use turn signals more, please? This is I'm taking this moment. I'm standing on my soapbox to say, fucking use your turn signals. They come standard on every single vehicle. I don't care how expensive or inexpensive it is. But like, you go through the walkthrough, you get familiar with what's available. And then your instructor likely would go, okay, so now we're going to turn the car on. Now we're going to take it from park, move it into drive. You're going to ease your foot off the brake, and then you're going to slowly step on the gas. And right, they talk you through. So what I'm asking you to do now, I probably just clunked my microphone. Sorry about that. What I'm asking you to do now is to just go in and get yourself a little bit familiar and start to break down that overwhelm that you may be feeling about the stock market. Now, if you're keen to look up a bit more of what I shared today, like I said, Google ARK Invest. You should easily be able to find the ARK Invest website. If you're feeling really daring, search ARK Kathy Wood in YouTube, and it's Kathy with a C. Check her out on YouTube. You can find an interview or a portfolio update or two. She's, I don't want to say flat. She's very intelligent, but she's not like me. She doesn't need to be, but she's much more like pragmatic. So if you go in and you're like, wow, this woman seems like she's kind of a dud. She's incredibly intelligent. And I think just based on how I've heard her speak and the way things that she says and kind of what she talks about, I think that she's very warm, but she lives in finance and well, that's all I'm going to say about that. Sorry, Kathy Wood, if you are ever listening to this podcast, first of all, I'm deeply honored. And second of all, please know that I think you're amazing. All right. I will warn you that you can go too deep into the wormhole. So very often when you do, right, when you start going too far down, you will find yourself into that like hyperventilating in a paper bag kind of overwhelm. That is not the goal. So the goal, I need you to keep this in mind. The goal this week is to just build your foundation, to expand your knowledge a little bit at a time. You're not becoming an investment expert overnight. You're literally just going to go spend like an hour maybe in total this week on this exploration. If you're feeling a little bit nervous, if you're like, fuck, this is a really big growth edge for me, set a timer for 10 minutes. And when it goes off, shut down all your research and just chill out until you meet me here again next week. All right? I just want you to start getting used to it, starting to understand it a little bit better. It will grow. And the first few times it's going to feel like, what the fuck am I looking at here? Whew. Okay. This was a really juicy, jam-packed episode. Let me know how you love this episode. Please take a moment to rate my podcast if you haven't already. It helps me so much to reach more people. I really, really believe that not just this specific episode and the knowledge about investing, but everything that I share on the podcast, I do it with the highest intent because I just believe this information needs to get in the hands of more people. So let me know what's resonating with you. Pop it in the review. Your reviews help motivate me to create more episodes, and I really love hearing from you. So thank you for listening to today's episode. Thank you for sending in your reviews. If this was helpful and you feel so called, I would love it if you share this episode with a friend. You know, that whole sharing is caring business. And if you feel so inclined, like take a little screenshot of you listening to the episode and tag me on Instagram. You can find me at Amy Van Meel, which I always have in the podcast show notes. If you have questions that you would like me to answer on the podcast, I have a portal now that you can submit questions. So you go to amyvanmeel.com/podcast questions to submit it. I, of course, have the link in the show notes. When you get there, you'll have an option to add in up to 3 questions. You can add more. You just have to submit a new form, but send in your questions. I'm excited to hear them, and I will do my best to respond to them on the podcast. And I've mentioned a couple of times my transformational money program called Building Fempires. So this is a 7-week program that's specifically tailored to meet you where you're at now and help you grow to where you want to be financially. In 7 weeks, I teach you foundational principles about money. I share secrets about why women in particular are kept in the dark about money and thus kept away from embodying our true power. I show you how your mind works, how you can finally and completely shift your belief set so that you can stop fighting the old programming and instead build the amazingly abundant life that you've desired for so long. And I light the path for you. I show you how to find and embody your most unfuckwithable self, that badass boss vibe babe that knows her power, embodies her power, is magnetic as fuck to everything that she wants, so much so that her desires can't help but manifest. Enrollment is opening up again very soon at the time that this episode goes live. So this means it's your perfect opportunity to join me and countless others and massively change how you view, earn, play with, invest, save, and spend money. At the end of 7 weeks, you'll have a deep foundational knowledge about money for practical everyday life, and you will be well on your way to living the outrageously abundant life you've always dreamed of. So sign up for the Building Fempires waitlist so that you're ready the minute the program opens for enrollment. To grab the waitlist, go to amyvanmeal.com/money waitlist. All right, my love, next week is a really juicy episode. I'm anticipating that we're rounding on an hour now. So I'm anticipating that next week is probably going to be approaching like a 90-minute episode because we're going to be diving into how do you get started investing. I'll be sharing more deeply about my own journey. We're going to bring all this knowledge that we've been building these last 2 weeks together as you prepare to make the leap from curious student to fearless investor. And with that, my love, I wish you an absolutely amazing day, week ahead. I am so excited to see you here again next week. Thank you for everything. Bye for now. Thank you so much for tuning in to today's episode. If you loved what you heard today, be sure to share it with me by leaving a review on your favorite podcast platform and help me reach more like-minded people who are ready to expand their life. If you haven't yet followed me on social media, find me on Instagram for extra love and inspiration by following at Amy Van Meel or visit my website at amyvanmeel.com. I love you so much, babe, and I am damn proud of you. I am already excited to connect in the next episode. And in the meantime, believe in yourself with the confidence of a 5-year-old.